Hey, it's Tom here and welcome back to the channel. So just yesterday, as I'm recording this, so on the 30th of August 2021, it was none other than Warren Buffett's 91st birthday. So as a little belated birthday celebration for Mr. Warren Buffett, I want to kind of share a couple of my favorite examples of really successful investments that Warren Buffett has made over the years. So I think pretty much everyone has heard the story of the more popular investments that Buffett has made. So the big stakes in Coca-Cola or See's Candy or American Express. And I really don't want to repeat those stories another time because they've been told very well already. But I want to share a couple of maybe the investments that don't quite get as much attention as I think they deserve, and some of the investments where we can hopefully learn a few things and see some of the frankly just straight up genius moves that Buffett has made over time. So in this video, we will talk through two of those really successful and very impressive investments from Warren Buffett. I'll also give an honorable mention to a third investment. The third one is one that you almost certainly will have heard of before if you've been following Buffett for any length of time, particularly in more recent years, but I think it's one that deserves a lot of attention because it was ridiculously impressive in my view. So before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been my personal broker of choice for me as a Kiwi making my US share investments for more than a couple of years at this point. When I first got started investing in US shares, I had to go through one of the big banks here in New Zealand. The options were very kind of few and far between, and they were always very difficult to use, to the point where I had to get on the phone, which every millennial, of course, hates to do these days, had to get on the phone and actually call the broker to make some of these trades. And because of that, they were also very expensive. So since Hatch has kind of come into the marketplace here in New Zealand, they've wiped out a lot of those barriers to entry. They've got a really simple online platform that's very easy to use, and the fees are just ridiculously cheap compared to some of the big banks. So I can do trades for $3 in Hatch that I was paying $90 to do previously with one of the big banks. And Hatch are constantly improving the platform as well. So one of the new additions that they made to the platform this year was the launch of kids accounts. Now, we all know that one of the main advantages of investing and one of the main forces that drive sort of wealth creation over time through something like the stock market is, of course, compounding and kind of just letting your investments snowball over time. So no one has a longer time horizon than people being born today. They've got a very long time before they end up retiring, so they can have that snowball compounding effect working for a very long period of time. And that snowball compounding effect is so powerful that it can turn an investment as small as about $2,000 into $1 million by the time someone being born today turns 65, if historic market rates of return are anything to go by. So if you're interested in checking out Hatch's kids accounts or Hatch in general, you'll need to head to the link hatch.as/investingwithtom. If you go to that link, sign up and start a new Hatch account and deposit your first 100 New Zealand dollars into that account. Hatch will give you a free $20 top up so that you can get started investing with a little bit more money. Okay, so for this first investment story from Warren Buffett, we're going to have to kind of flash back to 1998. In 1998, smoking had just been banned in California bars and restaurants, and the Denver Broncos had just won the Super Bowl, and the stock market was roaring to all-time highs, getting towards the end now of a tech bubble and a long boom in the stock market in general. And at the time, Warren Buffett, through his company Berkshire Hathaway, had made some very successful investments. After buying into Coca-Cola over 10 years ago at this point, it had rocketed up to over 45% of his stock portfolio. He had captured about a 13x return on Coca-Cola at that point. And he had a phenomenal track record. He still does today, but at the time it looked even more impressive. He'd been compounding at the high 20% per year range, very close to 30% a year. And his stock had kind of reflected the fact that Buffett had a very good track record and people wanted to kind of come along for the ride. If you've been a long-time follower of Berkshire Hathaway, you may know that Warren Buffett often uses something like a price-to-book ratio for the valuation of Berkshire, the valuation of his company, and he's now these days authorized to buy back stock at anything below about 1.3 times book value. Well, at the time in 1998, the price-to-book on Berkshire was closer to 3 times book value. And that was a very, very expensive price for a business that was still mainly concentrated just in a couple of industries. It was definitely first and foremost an insurance company. They had a couple of other businesses that they bought over time. Of course, they had See's Candy by this point, but they didn't have the big utility businesses like Berkshire Hathaway Energy, and they also didn't have the railroad, which again is one of kind of the big businesses for Berkshire today. So for a company that was mainly concentrated in insurance and also had a really large and successful stock portfolio, a price to book value much higher than 1 was starting to become a very, very expensive price. So for it to be trading north of 2 and kind of approaching 3 was really a quite overvalued point in Berkshire Hathaway's history. But what Buffett did next in that situation is extremely impressive. And this is a story that I have to give a shout out to Chris Bloomstrand on. Chris Bloomstrand is a very long time investor in Berkshire Hathaway, and he was also a guest on Tobias Carlyle's podcast back in early to mid 2020 and sort of recounted the story, which is where I'm getting a lot of the info for this particular video. So shout out to Chris Bloomstrand and shout out to Toby Carlyle for introducing me to Chris via his podcast. So here we were. Berkshire had a very successful track record. The stock was quite expensive, and the opportunity also just came up for Berkshire to buy a company called General Reinsurance, or GenRe as it's called for short. Now, General Reinsurance was going to be a very, very big deal for Berkshire Hathaway. You may know that one of Berkshire's main sort of business models through its insurance companies is to take what they call insurance float, basically premiums that are paid before people kind of claim on their insurance policies and it gets paid back out again. That money that just kind of sits in limbo for a period of time was basically getting invested by Buffett at very high rates of return, and they were essentially able to boost up their returns on equity in the business by taking money that was essentially borrowed from the float of these insurance companies and earning money on that. So, you know, people are basically paying you to look after your money because you're making profit on your insurance operations, and then you're also able to earn on that money as well. So, phenomenal situation for Berkshire, and the opportunity to buy GenRe would actually triple the float at Berkshire Hathaway. So it was a really interesting deal for Buffett at the time, but one of the problems that he had is kind of trying to figure out what's the best way to actually pay for this. There wasn't a huge amount of cash around at that time for Berkshire. There certainly was some, but probably not enough to make this acquisition. So he had a couple of choices. Either he could start selling some of his stocks. If he sold Coca-Cola, which was trading at quite a high multiple at that time, you know, approaching 40 or 50 times earnings when it was getting really, really stretched in kind of the booms of the stock market. That was one thing he could have done. He could have sold out of those stocks. The problem with that is he would have had to pay a lot of capital gains tax, which according to Chris Bloomstrand at the time would have been about a 35% capital gains tax, the same as the corporate tax rate at the time. So would have been a pretty big tax bill if he did end up selling Coca-Cola. So Buffett ended up looking for other options. And I guess staring him in the face, as we talked about slightly earlier in the story, is that Buffett had a really overvalued stock. So instead of using cash and instead of selling some of his stock holdings and things like Coca-Cola in order to pay cash for GenRe, he actually basically paid for this acquisition in shares. So rather than paying GenRe in cash, they basically formed it as more of a merger, and GenRe shareholders actually received either 0.0035 Class A shares for every GenRe share that they owned, or 0.105 Class B shares at the time. So essentially the outcome is that you acquire a business that triples your float, which is very, very attractive from a Berkshire Hathaway perspective. It means that GenRe is probably now accounting for very close to 1/3 of the overall value of Berkshire. So about 30%, call it roughly, of the value of Berkshire after this transaction, and he gave away 17% of the business to do that by issuing shares. So if you can acquire something that's going to be roughly a third of the value of your business after the transaction by only giving away 17% of your company, that is clearly quite an attractive deal. And it also really diversified Berkshire away from a fairly expensive stock portfolio as well. Okay, so the second investment I want to talk about in this video is actually one that in the 80s and 90s was quite a well-known investment of Warren Buffett's, but it's really not one that gets a lot of attention today simply because he doesn't own it anymore. And this was actually in Gillette. So Gillette was an investment that Buffett described as one of the inevitables. So he actually wrote about this in some of his shareholder letters through the 90s, and he said this about, quote, the inevitables. No sensible observer, not even these companies' most vigorous competitors, assuming they are assessing the matter honestly, questions that Coke and Gillette will dominate their fields worldwide for an investment lifetime. So Gillette had an extremely dominant business. In 1993, they were about 60% of the total market share of shaving products at the time, and everybody's fairly familiar with kind of the razor blade model in business. So the razor blade model is basically Gillette or Schick or one of these shaving companies goes out and they sell the actual kind of razor for either a very small profit or potentially even a loss, and then where they make a lot of their money is by customers basically purchasing the blades that fit on that razor that they sold in the first place, and that is where they can make a lot of money, and it's a very, very sticky product. If someone has a good shaving experience with Gillette, the first time they use their products and they've invested a small amount of money, got this sort of sunken cost fallacy in this razor, they're probably not going to go and switch to another brand. It's not the type of product that you typically do a lot of experimenting with. So seeing this very profitable business and this big competitive advantage that Gillette had, in 1989, Warren Buffett bought $600 million of Gillette preferred stock. So interestingly, he didn't actually buy the common stock in Gillette, instead he bought preferred stock. At the time, the preferred stock was paying close to a 9% dividend, 8.75% dividend. So he was getting a lot of kind of cash flow on that preferred stock. And the interesting thing with these preferred shares is that after 10 years, they could be converted to common stock in Gillette at about $50 per share. And it was interesting to see Buffett kind of later recount that he was probably being a little clever by buying the preferred stock of Gillette rather than just straight up buying the common stock back in 1989. In his 1995 letter, he said he was being far too clever and that Berkshire would have been $555 million better off if he'd kept things simple and just sort of bought the common stock. So his stake would have been an extra $625 million, sort of greater than it currently was at the time with just the preferred, at the cost of only $70 million in dividends. So in hindsight, it was sort of a mistake not to just straight up buy the common, but nonetheless, it was a pretty successful investment for Buffett. Now, where this again gets very interesting with Gillette and sort of Warren Buffett is actually the way that he exited the Gillette investment. So Buffett never technically actually sort of sold directly out of Gillette. Gillette was actually acquired by Procter & Gamble in 2005. And again, just like the Gen Re transaction we talked about, this was actually an all-stock deal. And one of the important things to note there is that this was sort of, a tax-free transaction for Buffett. So he wasn't selling out of Gillette and locking in a capital gains tax. Rather, it was treated more as a merger, and he received Procter & Gamble shares as part of this deal. So that all-stock deal in 2005 was valued at about $57 billion. At the time, Buffett owned about 9% of Gillette, so that valued his stake at a little over $5 billion. And if you run some sort of compound interest calculator type numbers on that, that means Buffett had earned about 13.5% per year plus the really fat dividends that he was getting initially from the preferred stock, and then of course slightly smaller dividends from the common stock leading into this deal. So here he was with now roughly 100 million shares in Procter & Gamble in 2005, and he actually exited that position in about 2 different sort of transactions. So he actually ended up selling about half of his stock a few years later when he bought Duracell. He bought the Duracell business from Procter & Gamble. He traded about half of his stock at, a few years down the track after the initial merger from the Gillette deal. He traded about half of his stock, which was worth about $4.7 billion at the time, in order to acquire Duracell. So Procter & Gamble were essentially kind of retiring that stock, almost kind of quasi buying it back, and Berkshire was left with the Duracell business. The interesting thing is Procter & Gamble had actually just put about 1.7 billion of cash into the Duracell business. So if he was giving away 4.7 billion in stock, the business has 1.7 billion of cash in it. The net cost is only about $3 billion for that Duracell company. And I'm no accountant here, but as I understand it, that again is a very tax advantaged kind of transaction as opposed to just paying cash and, you know, selling some of your Procter & Gamble shares kind of directly for cash and then paying a capital gains tax on it and so on. So that's how he got rid of about half of his Procter & Gamble stock after the initial merger with Gillette back in 2005. And then finally, he sold the other half of his stock not until 2016. It was actually not the best performing investment from 2005 to 2016. He only captured about a 40% gain over that sort of 11-year period, which is, you know, not a terrible result, but by Warren Buffett standards, it's not impressive at all, you know, when he's cranking out 20 or 30% a year here. So he ended up selling the remainder of his stock in 2016. But recognizing that Gillette was a phenomenal business and a very, very sticky product, and going through a couple of these transactions with mergers and so on and making sure to keep them as tax advantaged as possible, I think is very impressive from Warren Buffett. Now, before we wrap up this video, just the third and final investment that I want to mention is actually Apple. Now, I know that pretty much everyone at this point is familiar with Buffett's Apple investment, but I just want to kind of talk through how he actually bought into Apple and how long a time he spent buying into that position. So, the reason that this is really impressive to me is that Apple was very near the biggest company in the world at the time. And typically when value investors are buying into businesses, oftentimes they're kind of small, underfollowed companies. Buffett doesn't really have the luxury of hunting around those smaller names anymore. He's kind of restricted to buying into very, very large companies just as a result of his sheer size. He's a bit of a victim of his own success in that way. But to go out and buy a massive stake in Apple just in broad daylight over a very, very long period of time and still have it work out extremely well is quite impressive to me. So at the time when Berkshire first started buying in Q1 of 2016, it was actually initially a sort of Todd investment. The share purchases didn't ramp up really, really aggressively until a couple of quarters later, as I'll talk through in a sec. But you know, Apple is a phenomenal business, and I think everyone kind of recognizes that today. But at the time, the market wasn't pricing it as such. It was only trading at a PE of 11. Interestingly, Apple actually had a massive, massive stack of cash in Q1 of 2016 as well. So if you include that cash and look on an enterprise value to, say, EBIT basis, it was only trading at about a 5 or 6 multiple in a EV to EBIT term. So very, very cheap on that metric. And they also had very clear intentions to return that cash, whether it be through buybacks or whether it be through increased dividends over time as well. And if you compare that to some of the multiples today, Apple trades at about 29 times earnings. So the PE has gone from 11 to 29. And the EV/EBIT has gone from 5 or 6 up to 24. So they've distributed out a lot of that cash. The sort of delta between a PE ratio and an EV/EBIT multiple is really not as wide as it was in the past. And it's been about a 6x return for Buffett since those first investments, plus any dividends he's been paid. So to finish off the Apple story here, I'll just talk through briefly what the actual purchasing history of Apple looked like at Berkshire. Because like I say, it went on for a very long time, and I don't know that a lot of people really followed him into this investment, and it worked out to be very, very successful. So Q1 2016, Berkshire bought their first shares in Apple. They bought 39.2 million shares. That only represents about 0.8% of the portfolio at the time. So very small position, and at this time it was probably that initial sort of Todd investment, but things ramped up a bit in the following quarters. So Q2 2016 they bought 21 million shares. Q3 2016 they actually bought nothing. Q4 2016 is where things started to get pretty serious, and they bought 168 million shares. Q1 2017 they bought 287 million shares. Q2 2017, they bought 3 million shares. Q3 2017, they bought 15 million shares. Q4 2017, they bought 124 million shares. Q1 2018, they bought 296 million shares. Q2 2018, they bought 49.5 million shares. And Q3 2018, they bought 2 million shares. So a very wide range in sort of shares that they bought from quarter to quarter. But in there, they were buying pretty aggressively. The first really big buy, 168 million shares, was Q4 2016, and the last big buy of 296 million shares was in Q1 of 2018. So over a fairly wide time frame, Berkshire were buying into Apple. And right now the portfolio looks pretty similar to what it looked like in 1998 with the Gen Re story. It's certainly still trading in the 1 something times book value range. I'll put that up on the screen here. It's nowhere near the big 3 times book value it was approaching in the late 90s. But it's kind of reminiscent of that time. You now have Apple making up about 40% of the portfolio. Coke was doing that in the late 90s, and Apple is certainly not Buffett's most successful investment in terms of a multi-bagger, but in my eyes, it's potentially his most impressive ever in terms of just being able to go out and buy it in broad daylight with a massive, massive sum of money. So again, a belated happy birthday to Warren Buffett, and those are a couple of my favorite investment stories from Buffett's career. That is really it for me for this video. So if you've got any other favorite kind of Warren Buffett investment stories, definitely drop them down in the comments below. If you're interested in checking out the Hatch offer, feel free to go to the link hatch.as/investingwithtom. But like I say, that's it from me for this one, and I will see you in the next video. Cheers.